Hello everyone, and welcome to our market alert video for today, which is 9/26/25. I hope this video finds you healthy, wealthy, and wise. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America, and we have a ton to talk about, and we're going to have more fun than a human being should be allowed to have when talking about all of this boring financial stuff. So we're going to talk about GDP, our gross domestic product, all the goods and services we provide in this country, and it was revised up to 3.8 from 3.3. So what does that mean? We're going to talk about the jobs data and why it came in better than expected, but that's actually bad news. How can that be? We're also going to talk about new home sales. Wow. Blew the top off of August. So we'll talk about that. And then also we're going to talk about what we think is developing here, which is a bubble on the order of maybe Y2K, and you may recall that back in Y2K, the stock market went down over 49%. The S&P 500 index did, and for that bear market to play itself out, it took 2.5 years. And we're going to talk about what you should do to protect yourself from that. So we have a lot to talk about. But before we dive in, I want to share with you. Last week, I mentioned that I was going to be spending the weekend with my 4-year-old and my 6-month-old grandchildren because my daughter and her husband are wanted to go out of town and celebrate their wedding anniversary. And everybody said, Ken, you better be ready. They are going to wear you out. You're going to have to take a nap. And I said, okay, I'm going to work out, get mentally prepared. I'm ready for this. I accept the challenge. And so when we went to visit, I was prepared. We did paper airplanes. We made rocket ships. My wife had us make pizza from scratch, and then we ate it. It was so much, and every night he was like, he was ready to go to sleep. I won. I was not going to let that little boy wear me out. I was going to wear him out. And also something nice happened, and that is that I was in Houston, as I am now. And we had a client event, and we had lots of clients there. It was very nice. Always nice to meet with clients. I love doing that. And we had a client that came up to me, and as you guys may know, when a client of ours retires, we call them a SCWPR. And SCWPR is the acronym for Second Childhood Without Parental Supervision. And so when a client retires, we tell them to go play, have fun, enjoy your second childhood. And so this gentleman and his wife came up and they said, Ken, just want you to know we've been SCWPRs for 12 years. We've been SCWPRing for that long. And I want to thank you so much. And I said, really, that's fantastic. And he says, yeah, we have more money today than we did back then. And we've been SCWPRing this whole time. So you guys are doing a great job for us. Thank you so much. And that really makes me feel good. And then it seems like when it rains, it pours. I was talking to a SCWPR that I work with personally, and she said she's 95 now. She's been a SCWPR for 28 years. And when we were talking, she said, Ken, I don't even look at my investments. You guys have been taking care of it for me. I don't worry about it at all. And thank you for doing that. It's the best decision I ever made. And I said, Pat, you're 95 years old. You have so many stories that you could share. And I said, would you be willing to do a podcast with me where we can explore your life? I mean, 95 years ago, or, when you were, let's call it 85 years ago, when you were 10 years old, I'm sure you have lots of stuff to share and, what it's like to be retired and teach all those young whippersnappers, a few things. And she said, I'd love to do that on one condition. And I said, what's that? You tell me what a podcast is, number one. And then number two, that you come to my house to do it. I'm not coming to you because she moved out of town. So we're going to do that. I can't wait to share her with you. That's going to be great. So let's get into the boring financial stuff. GDP. So this is the goods and services that we produce in this country, and was revised up from 3.3 to 3.8. For an economy our size to be growing at 3.8%, that is really, really good. It's actually phenomenal. And the concerns about tariffs and all those things slowing us down and all that do not seem to be materializing at this point. And our economy is just humming. So that's a good thing. And a reflection of that is jobs data came in stronger than expected. Now, you would think that jobs data coming in stronger than expected would be a good thing. But as we've expressed in the past, it's a bad thing from the standpoint that the Federal Reserve wants to lower interest rates to help the job market. But if the job market is doing fine without their help, then they won't lower interest rates as much. And investors, stock and bond investors, they're all like, we want interest rates to go down. Please, please give us lower interest rates. We want them so badly. Well, they may not get as much as they wanted. And when that happens, investors sell. So we could see a little pullback here in the interim before it ebbs back in the other direction again. The one thing also that was really cool to see, and that is that in August, new home sales rose by 20.5%. Think about that, 20.5% in 1 month. That is phenomenal. And this was on the assumption that the Fed was going to lower interest rates, which they did. And so if the Fed does, in fact, lower interest rates 1 or 2 more times this year, we can see the real estate market really going. And that's a huge positive because real estate represents 25% of our economy. And if it's growing, then people are buying refrigerators and carpeting, and they're renovating their homes and putting new roofs on, and jobs and all this kind of stuff is going on. A lot of business activity, and that's a very good thing. But in the short run, people want lower interest rates right now. Bring them. And if we don't get them, we might see a little bit of a temper tantrum. So all in all, as I always say, if you don't watch these market alert videos, you do it at your own peril, because we said at the beginning of the year, we did not think that we would see interest rates go down until after the July meeting. In fact, it took till September. Back then, many of the big banks and others were saying that 3 or 4 interest rate cuts this year. By March or by May? Well, that didn't materialize. So so that's all the good news. Let's talk about the bubble that we see potentially building here, and that is the AI bubble. If you look back at 2 major infrastructure buildouts, the railroads, the internet, and now AI is a third one, major change, major infrastructure change in the history of our country. If you look at those other 2, they both had very similar behaviors as what we're seeing now. There was huge enthusiasm about these things. The internet is going to change everything. It's going to revolutionize. It's going to create productivity. People are going to be able to sell their products. It's just going to be fantastic. And so people invested in anything that had to do with the internet and created the .com bubble. Well, the problem was that nobody knew how to make money with this thing at that time. And so all these companies that, had their stocks go up so much, suddenly people were saying they're not making any money. There's no profits there. This thing is a joke. And those stocks went down 90% in Y2K. And so where are we today? Well, back then, the companies in the aggregate that their stocks were affected by the internet construction of that infrastructure, they came to be 30% of the S&P 500 index of the stock market. Well, where are the companies like IBM, NVIDIA, Microsoft, and Facebook, all these companies that are on the forefront of building out the AI infrastructure? Well, they're at 25% currently of the value of the S&P. So they're approximating that 30% in Y2K. And even Zuckerberg and Altman, the 2 leaders of this whole thing, among others, are saying we're in a bubble right now. Now, if you look at those companies that are in the S&P that are part of that 25% I just described, their stocks are up about 100% over the last 2 years. Does that sound like the definition of a bubble? If you go back to Y2K and you look at those stocks, they were going up 20, 30%, 50% in some cases per year before the bubble popped. So this is very similar to Y2K. And as I said, the stock market went down 49% and in that Y2K bear market, so call it half. And that whole thing played itself out over the course of 2.5 years. And many people lost a lot of money in that whole thing. And if you think about it, back then, 30% of the stock market was related to the internet. And when that bubble burst, those stocks went down 90%. Even very big companies went down 90%. And that's 27% just from those companies. But then what happened is everybody else freaked out and sold everything else at the same time. So is this going to happen this time? I don't know. But what I do know is at our firm, we have what we call invest and protect. It is a strategy to help us to protect our clients from a bubble that forms and then bursts and takes the market down like that. We protected our clients who followed our advice in 2008 from the big bad bear market that happened then, where that was actually a 57%. Clients who followed our advice didn't lose any money during that stock market crash because they were out of the market during that whole time. So if you're retired or retiring soon, we want to protect you from potentially a next big bad bear, and AI may be it. I don't know. But why not protect yourself from that? Invest and protect. And that way, if you want to retire, you have a modicum of confidence that you can still get there or stay retired. So if that interests you, please visit with us. I'll offer you a complimentary visit where you can come in and visit with us. We'll build a plan for you, no charge or obligation. We'll show you our invest and protect strategy. We'll go through the whole thing with you. At the end of that meeting, if you like what you see and you want to work with us, that's fantastic. And if you don't, that's fine too. There's no charge or obligation, and we will part friends. Okay, so thank you for watching this video. Please like and subscribe and tell your friends about it, share it with them. And I hope this video did find you healthy, wealthy, and wise, and we'll talk soon.
Retirement Planners of America.